traditionally, good-looking people have been models. There is no difference here. I don't think it's a bad thing to have good-looking people modeling your clothes.
But I tell you the key thing that this has done, right? It's obviously ignited a viral argument.
You should never try and appease everyone.
Yeah.
You should find the niche that is going to pay you the money. People who are criticising Sydney Sweeney or American Eagle for the Sydney Sweeney ad would never have bought American Eagle anyway. They were never the customer.
Yeah.
So why does it matter what they say? It literally doesn't.
So, meme stocks are back. Retail traders are piling in. All of the hedge funds are getting nervous and Reddit is blowing up.
Yep, we're talking surge in share prices, short squeezes coming out of nowhere, and a whole new wave of market chaos.
We'll reveal which meme stocks are the ones in focus and what is driving that hype.
And how you can avoid the trap, spot the next breakout to make sure that your portfolio is perfectly constructed.
And we'll also look at whether this latest meme stock craze could give us the next Gamestop. So we'll start off with meme of the week. And I think we can all relate to this meme. My watch list is definitely punchier than my portfolio.
Yeah, definitely. I think one of the most common things that I hear from retail investors is that they do not have a system to actually take what they see on their watch list and be able to then action it. So they see all of these stocks on their watch list going ballistic, and then the portfolio does nothing because they don't actually know how to go from, okay, here's an identification of a stock that might move, to actually saying, okay, I'm going to trade it now. That purely comes down to systemization. Most people are punting.
Yeah.
They don't actually know what they're doing. And I think that is the biggest problem and what this meme's identifying.
And I think one of the key things is why you put things in your watch list and why you put things in your portfolio. Now, the main thing is it takes balls to put them actually in your portfolio. You actually have to do something. We spoke about this before, about the risk appetite, of a lot of retail traders, and it's like minuscule amount of risk appetite. And of course, to put stocks in your portfolio, you actually have to place the trades. You have to go in and take the risk on. And that's half the problem. People are so nervous. You do the research, they'll go in the watch list, and then they don't go in the portfolio. Yeah. Because, you just got to trade. So much. We look at volumes in retail trading a lot of time, and a lot of those volumes are pretty low, right? And they don't. I think this risk appetite thing is a key one, and I think it comes in here. I think risk appetite is key within investors.
Well, I think there's a British issue there.
Yeah.
British investors, that's very specific to and absolutely a problem.
Yeah.
If you look at American and Indian investors, though, Indian investors especially, they have more exchange-traded derivatives volume than the US. So it's definitely a cultural thing. US investors have about 47% of households owning equity exposure. The UK, it's about 10%, which is insane. And so I think it's very much a British issue. And the appetite amongst Americans, amongst even the Indians, is completely different. There's a completely different risk appetite. Yeah. So I think that's a really interesting divergence there that we've got between different nations.
And I think is there not a degree of that goes into circumstance as well? Because if you're living in the UK and you are a British investor, the chances are that financially you're less powerful than you've been pretty much ever.
Probably, yeah. I think there's an obsession with property, though. So a lot of capital goes into property, and then you don't have much left to actually put into...
And at the moment, everyone who's got money in property can't actually get that money out because you can't sell any houses.
Well, yeah, and also, you're then foregoing the opportunity to invest in things that are liquid. Everything, as you say, in property is illiquid. It takes maybe 3, 6, in some cases on Rightmove recently, I've seen 12 months of no sale going through on some houses. So I don't know why people prefer the illiquidity of a home over the liquidity of, say, US equities, for instance.
Here's a question. What tip do we give to retail traders for getting that stock from your watch list to your portfolio?
The actual strategy that I say to people that has never invested before is use the bank statement strategy. So you go through the last month of your bank statement, you find a company or a transaction where you have maybe done it once a week. So let's say a Tesco shop. You then, without thinking, just go and buy one share. That then keeps you invested at looking at what that company's doing. And then perhaps you can do that again with another company. It might be JD Sports, for instance. If you've been there, bought a new pair of trainers, just by doing that, you're shifting yourself along the risk curve in a very, very easy and quite systematic way. Because what you're able to do then is, if, say, you stop buying from Tesco, there's probably a reason. Maybe the food prices have gone up too much, which then means that Tesco is probably going to experience fewer people going and shopping at Tesco, which might then have an impact on their profit. You are then analysing that stock through your own personal experience, but also adding some objectivity to it as well.
And you've got to think that if that's you, it's also millions of other people.
Exactly. That's exactly the point. And so it compounds, you're then able to make a case and then you can translate that into other stocks. It's just about gaining practical interest along the way.
And that's a great entry level tip for anyone getting into retail trading.
Exactly.
Okay, so let's go on to the tweet of the week. And this goes in, we're into meme stocks, right? So a bit of context, I suppose, around
controversy.
And controversy.
I love that.
A bit of context about meme stocks, right? Meme stocks are anything that basically is going viral on Reddit. And I was called a dinosaur earlier because what did I call it? Reddit.
You called it Reddit boards.
Reddit boards, yeah. I was called a boomer.
Shocking.
Ouch.
Yeah.
Anyway, so anything that's on Reddit, the most famous example of this is GameStop, right? Yeah. What happened with GameStop. Now, this has all come about recently. American Eagle is one of them. These are the tweets. And of course, we're looking at two tweets here. We've got American Eagle and Nike.
Yeah.
Right. And there's been significant shifts in their advertising strategy.
Yeah.
Which, of course, is leading to the popularity from a meme stock perspective.
Yeah, I think, American Eagle is a slightly different case to Nike. However, last year I'd mentioned that Nike had followed a strategy of focusing on a broad base of people, whereas
normal people.
Yeah,
right?
when previously marketing works by selling a dream. Yeah. Let's put it that way. So Nike used to sponsor Tiger Woods, Cristiano Ronaldo, Wayne Rooney, the very elite at the top of their game. They hadn't really done that for a long time. Now, recently, they put out this advert of Scotty Scheffler. Now, golf fans won't know who non-golf fans, will not know who Scotty Scheffler is.
Yeah.
But he is the best player in the world currently.
Yeah.
So putting this advert out whereby it shows him as a family man with his son on the green after he's just won the Open. And it says on the second part of it, there's always one more major won't hurt though.
Yeah.
So it's showing him as a family man, but then saying, yeah, you can do that, but also be the best golfer in the world. Before they weren't doing that. They weren't showing that elite side. People want that because they want to feel the emotion of feeling like they can also be elite, even if you're just buying a pair of trainers.
But it's aspirational, isn't it? It's
exactly.
Aspirational things. And somewhere along the lines, we shifted from selling aspirational goods, and selling them or using aspiration as a reason to buy something. Well, you buy these golf clubs because you want to play golf like Tiger Woods.
Yeah. Aspiration became a negative for a long time in marketing.
Yeah.
Being normal became what people should achieve, and it's okay to just be normal, when in actual fact, even in the most normal people or under average people's heads, they still actually want to be elite.
Yeah.
It's the dream.
That's
why people buy. They buy based on emotion. They don't buy based on logic at the end of the day. And for a sports brand to suggest that remaining normal is what you should do, it doesn't make sense. And so that's why Nike shares got absolutely battered over the last couple of years, coupled with having management consultants as CEOs and on the board who are useless.
Yeah.
They just went well away from the culture. Now, in Sydney Sweeney's case, I think it very much is a meme stock because there wasn't necessarily that precedent set in terms of a real difference in advertising.
Yeah.
It's just Sydney Sweeney.
Yeah.
And so people just bought because, and we're going to get onto some data in a second.
But they've used a hot girl to sell clothes, right?
Yeah.
And the line is Sydney Sweeney's got great genes, right?
Yeah.
And which is incredibly clever, but a lot of marketing has moved away from using, whether it be male or female, using hot people to sell products.
Yeah. But we don't need to listen to insane people who have, no real grip on reality anymore, quite frankly. Traditionally, good-looking people have been models.
Yeah.
There is no difference here. It's just, for so long now, again, with the Nike example, it's been like, okay, well, yeah, just average is normal. Again, that aspiration is gone. I don't think it's a bad thing to have good-looking people modeling your clothes.
But I tell you the key thing that this has done, right? It's obviously ignited a viral argument between the left and the right, which everything does these days, right? Everything is an argument between the left and the right on Twitter or on social media. And that's what it's done. It's ignited this.
It's not even a left or right thing in my view. It's purely insane people, right, talking about insane things that don't matter. We can easily ignore them. They don't need to be, engaged with at the end of the day.
But for American Eagle,
shares are up.
They don't care either way. It's just free advertising because everybody's arguing about it.
It rallied 17% in one day after that.
Yeah, exactly. And it's all over Reddit. It's all over Reddit. And that's exactly why it's getting this meme stock angle.
Exactly.
Right?
And the other thing as well with marketing is that you should never try and appease everyone.
Yeah.
You should find the niche that is going to pay you the money. That's what a company needs to do. You're not supposed to try and appease as many people as possible. Apple, one of the most successful brands ever, they have so many haters.
Yeah.
And I actually hate that word. I've never used that word in my life. Microsoft is hated by Apple fans.
Yeah.
Do you see what I mean? Like, you shouldn't try and appease everyone. You should stick to who is going to pay you money.
Because inherently the world is tribal, right?
Yeah, exactly.
You have tribalism absolutely everywhere. So people are fighting everywhere.
People who are criticising Sydney Sweeney or American Eagle for the Sydney Sweeney ad would never have bought American Eagle anyway. They were never the customer. Yeah. So why does it matter what they say? It literally doesn't.
Plus, all anyone's talking about is American Eagle.
Exactly.
That's why it works.
Stock go up. That's
so, I mean, let's take a look at the chart for this. So, obviously, the chart has seen, as you said, they went up 17%.
17%. Yeah. I think alongside the overall market at the moment, though, we're having a little bit of a breather. Yeah. And we're going to get onto a couple of reasons why after this with the chart of the week. But look, if they're showing willing, now the broader case here is that they're showing willing to expand now into really revitalizing the brand. I think it had been battered for quite a long time.
Yeah.
And so showing that willing from the board to now try new things, it's like the Abercrombie turnaround.
Yeah, I was going to say about Abercrombie as well. Yeah,
we're following that kind of turnaround now.
And because those companies are so similar in terms of their product and in terms of their advertising strategies previously, the bad news rub from what happened with Abercrombie's CEO and all of the issues that went with that rub onto companies like American Eagle.
Perhaps, yeah.
They don't go the demise of a competitor there doesn't actually lead to an upside in American Eagle. It actually takes the whole lot down,
Possibly, yeah. The other thing as well that I think isn't noted is that I feel like fast fashion is becoming less popular too. I feel like people are returning back to traditional brands whereby, yes, it costs more, but they're kind of sick of buying, a £7 dress off of Shein or Temu.
Yeah.
Even though I guess incomes are suppressed. That's the vibe that I'm getting now.
Just a couple of things before we move on from that. But from a meme stock perspective, it's not just American Eagle, right? There's been runs in Wendy's was one that we saw.
Wendy's, Krispy Kreme,
GoPro,
Rocket. Insurance as well.
And I suppose the question people will be asking, well, how do I find out? There's not really too much of help you can give there, really, is there? Apart from you need to be on the right Reddit.
There are a couple of things to look at. So markets trade against positions. That's number one. So a lot of these have been heavily shorted. Now, what happens when a short squeeze occurs is naturally, as there's buying pressure, those shorters have to buy back their shares, which adds fuel to the fire. So during periods like this, when there's mania, you probably want to look for the most shorted stocks. Now, one that I mentioned to the guys in my community a couple of weeks ago was SMCI. So you had 18% short interest on the lit market, which is on exchange, but then you had 45% interest short in dark pools. Now, hedge funds operate in dark pools. They deal between each other. They operate off exchange a lot. When they're operating on exchange, if they're a market maker or doing latency arbitrage or statistical arbitrage, what they're looking for is minor inefficiencies in exchange traded markets, so pricing differentials. But in the dark pool market, what they're looking to do is just deal between each other. Now, that short interest jumped to 51% in the dark pool market, and the price of SMCI has gone from about $42 up to 51 now, I believe. I don't know literally right now this second.
Yeah.
So that's rallied quite a lot over the last month or two. And this is really where the fuel comes from. When there's mania, you're really looking to squeeze those shorts out of the market.
Yeah.
And I think a lot of hedge funds and other traders are wrongly positioned. But remember, there's going to be hedge funds buying as well, buying into that momentum. So some hedge funds doing the shorting because you can make alpha from shorting. Alpha capture strategy.
Although doesn't this come from the man who says shorting should be outlawed in markets?
Oh, yeah, but I don't short. It's only hedge funds that will run a long short strategy in the main.
Or retail traders that want to lose money.
Yeah, exactly.
That's another topic.
So if we actually look at the reasons as to why I think we've had this, so retail traders have won a lot since the start of the year, especially over Trump's tariff sort of reversal period when the tariff regime went. We can see that they were winning in the large caps, Nvidia, Microsoft, all of those AMD and things like that. Now what's happened is they're running out of money to buy more shares. So what are they doing? They're going down the hierarchy of risk or up the hierarchy of risk, whichever way you look at it. And so with this chart of the week, this is exactly what we're highlighting, this hierarchy shift now in terms of risk. They are getting riskier. So what the chart is showing here is that we're at the 98th percentile rank in history since 1990 in terms of share of total dollar trading volume. Now, in simple terms, it means that people are getting very, very frothy over buying penny stocks with enterprise value over sales multiples of 10 times.
Yeah.
Unprofitable stocks even at the 85th percentile. Now,
so these unprofitable companies, right? Unprofitable companies, people are still buying into these unprofitable companies.
Yeah, on the 85th percentile. So that's not really the biggest issue here. The biggest issue is the first two, 98 and 96%. Now, retail investors getting involved in penny stocks once they've depleted pretty much their capital in the large caps and the stocks that have had momentum since the start of the year, that is going to be a real problem because penny stocks are illiquid in nature.
Yep.
And also, they can get absolutely trounced by those with more information about those.
It's the same as
companies.
meme coins, pretty much.
To an extent, probably a little bit more regulated. But
not hard, but slightly. But in terms of how they can move, right? The markets can. Okay, you won't get rug pulls like you do in meme stocks, but you can get these stocks plummet to zero for no reason, pretty much.
Yeah, and I think the issue to take, or the easy way to surmise this, is that they're getting very, very excited. Now, when retail traders get overexcited and they move into assets like this, that tends to indicate to me that there's a bit of a softening of risk, let's say, i.e., I think the market's going to go down for a little period. It doesn't mean it's not going to remain in a bull trend, but I think that people are going to be surprised, especially over the next 2 weeks, 3 weeks, at what the market does. If you remember last year, start of August, we had a massive volatility spike. I think any funds that are looking at a 12-month look back are going to see that volatility spike and start factoring that into their models.
There's some macroeconomic stuff that can probably highlight this as well, or not highlight, can back that up, because actually today, as we record, we're getting the Fed rate decision, right? Fed likely to, Jerome Powell's going to ignore Donald Trump and going to leave rates on hold, right?
He's rich enough. He doesn't care.
Yeah, he's not.
He's
bothered.
worth 200 mil.
Yeah, so he's not bothered defying Donald Trump.
Yeah.
Yet, usually we would probably say, actually, well, market reaction to that, no one's really going to care because the likelihood is going to cut in September anyway. But because there's so much public focus on that, I think there's more of a negative connotation to him ignoring Trump and keeping rates on hold and higher.
Perhaps. I think it probably is time to cut, though, because inflation's been trending down now. The interesting thing will be if he actually does a surprise cut. That would be massive because it's priced in at about 95% for there to be no cut.
It would be massive.
Markets
huge. Would go
bananas,
ballistic.
Yeah. Which I think would be a very, very interesting case. But he's perhaps looking at the fact that inflation and also growth not so much, but inflation has been kind of going like that a little bit now. And so I think there could be a case, but again, unemployment is still hot.
Yeah, exactly. And that's something that's really not been hit whatsoever.
Or cold, if you like.
Yeah.
So perhaps there's not a case, but I wouldn't be. Let's say on an outside case basis, I would apply a little bit more probability than usual to there actually possibly being a cut tonight.
That's all down to Trump's pressure.
I don't know if it'd be down to Trump's pressure. I think he'd be looking at the data. But the market is not pricing anything in.
Whether he cuts to the cuts in September, difference is minimal, right? But in terms of market movement, would be crazy.
Yeah.
Well, central bankers particularly cautious usually, right?
Yeah.
Well, I'd love to see it.
It'd be interesting. It'd be very, very interesting. I mean, if you look at what happened last August, the cut right now could actually completely nullify that volatility. So.
Yeah. I mean, just going back to meme stocks for a second, I think what was really interesting from in the GameStop situation. Now, we mentioned previously, completely different market scenario, right? Yeah. Completely different situation. But what it does show is it shows the power that retail traders can have. Because a lot of time, retail traders are often passed away as... don't worry about retail traders, right? That's a nothing. It's just Joe Bloggs punting away wherever. But a mobilized community can make a big difference.
So one of the biggest things about retail trading recently, and Robinhood has probably been the ignition for this, is the extent of call buying. So options call buying. What happens there is someone has to write that option, a market maker. But then what the market maker has to do to hedge their position out, because otherwise they'd effectively be short the stock completely if they write the option, is they then have to gamma hedge, which means buying the underlying to make sure that their exposure is neutral. That has been a massive driver when retail have been buying these options, these call options on all of the stocks, whether it's Nvidia, whether it's Microsoft, doesn't matter. So there's been a passive bid from market makers on top of that, while retail have been succeeding in running this market up. Now, it's not just been retail, of course, that's been involved. That would not make sense at all. Commodity trading advisors been involved. Vol control funds over the last 2 months or so have been very heavily involved. And naturally the hedge funds too. But retail have definitely been a key participant in keeping this bid because it forces the market maker to also go and buy the stock.
Yeah. And I find it really interesting, the US focus from a options and futures trading to how that translates into UK, because no one trades options in the UK, hardly at all.
Well, maybe we should start forcing pension funds to, or start getting people to buy call options on UK stocks, because it will force the market makers to push the stock up.
I think it's too complicated here. We just go, nah.
Can't bother, rather stick it in a cash ISA, let inflation murder me.
Yeah, yeah, exactly. Yeah, apart from that, do you agree? Take a look at meme stocks, take a look at Reddit, take a look at American Eagle and all of these companies, because they're flying at the moment. Thanks for watching. Like, comment, subscribe, all of those things, and we'll catch you next time.